Hello class, and welcome to the video lecture for Notes Receivable and Notes Payable. Learning Unit 4 covers discounting one's own note, which is similar to a business taking out a loan at the bank. We'll also cover adjusting entries for interest. So let's look at the example in the textbook, which starts on page 532. Jones Company is borrowing $10,000 by giving Alvin Bank its own 12% 60-day note on December 16th. In this case, Alvin Bank deducts the interest in advance. Step 1 is to determine the maturity value, but since this is Jones Company's own note and it doesn't pay itself interest, the maturity value is the principal of $10,000. The second step is to determine the discount period, but in this case, since the note didn't come from another business, the discount period is the same as the term of the note, which is 60 days. The third step is to calculate the bank discount. The formula for bank discount is maturity value times discount rate times discount period. In this case, the discount rate is the same as the regular interest rate of 12%. Therefore, we have the bank discount equals $10,000 times 0.12 times 60 divided by 360. So the bank discount equals $200. The last step is to determine the proceeds, and proceeds equals maturity value minus discount, which is $10,000 minus $200, so the proceeds equal $9,800. Thus, Jones Company receives $9,800 and at the time of maturity will pay back $10,000. When a company discounts its own note, the interest isn't immediately recorded as interest expense. Instead, it's recorded in an account called Discount on Notes Payable, which is a contra liability account with a normal debit balance. Over time, this amount is recorded as interest expense in a process called amortization. You will see amortization more formally in a later chapter when we cover bonds. Notice how the account Discount on Notes Payable is presented on the balance sheet. Since it's a contra account, it's listed right under the Note Payable account and is subtracted from Notes Payable to arrive at a subtotal. This subtotal is the amount of the proceeds and is called the carrying value. You'll learn carrying value more formally later chapter when we cover bonds. Now let's record this transaction as a journal entry. The company receives $9,800 in cash, which is recorded as a debit. The discount on notes payable of $200 is also recorded as a debit because we increased discount on notes payable, and increases in contra liability accounts are recorded as debits. Finally, we record the note payable itself, which is a credit of $10,000. Let's review the process of accrual, which you learned in Accounting 110. To accrue means to recognize in the accounting books, by way of a journal entry, that income has been earned or expenses have been incurred before any cash has changed hands. So let's look at the bottom here, accrued interest income. You must adjust for income that has been earned during the period but has not yet been received or recorded because payment is not yet due. And then we have accrued interest expense. We must adjust for interest that has been incurred during the period but has not been paid or recorded because its payment is not yet due. The example in the textbook on page 533 says Bog Company receives a $24,000 60-day 10% note on December 16th from Jan Company. Adjusting entries are done at the end of an accounting period, usually December 31st. We need to determine the amount of interest to accrue on December 31st, even though the note has not reached maturity. Let's start by calculating the total interest amount. The total interest is $24,000 times 10% times 60 over 360, which equals $400. But that's for the entire 60 days. We only need to accrue interest for the amount of time between the issue date and December 31st. The issue date is December 16th, so we need to accrue interest for 15 days. If $400 is for the entire 60 days, we need to figure out the portion of $400 that applies to 15 days. We do that by multiplying $400 times 15 over 60, which is the portion of 60 days we need. So 400 times 15 over 60 equals $100. Bog Company, the seller, records interest receivable and interest income of $100. Jan Company, the buyer, records interest payable and interest expense of $100. Remember that it's important to record income in the period it's earned and expenses in the period incurred. We've done this by recording these adjusting entries, even though no cash will change hands until the next year when the note reaches maturity. Now let's look at what happens when the note reaches maturity in the next year on February 14th. We'd already recorded $100 of the total $400 interest. So now we only need to record $300 of interest. Remember that our principal is $24,000 and our total interest is $400, so the maturity value is $24,400. This is the amount of cash that will change hands. Bog Company records the receipt of $24,400 cash with a debit to cash. It then records a reduction to the interest receivable with a credit because it's receiving the interest now, and that amount was $100. It also records a reduction to note receivable of $24,000 with a credit. Finally, it records the remaining interest income of $300 as a credit. Remember, we had already recorded the other $100 in interest income the previous year, the accounting period in which it was earned, with the adjusting entry. Now let's look at adjusting entries when a business discounts its own note. This is described in the textbook at the bottom of page 535 with a paragraph that starts with the words, "the last adjustment." And that's 535. It's very easy to miss in this textbook, so I want you to please take a look at that. Remember earlier when Jones Company discounted its own note on December 16th, and we recorded the interest in advance in an account called Discount on Notes Payable. At the end of December, 15 out of the 60 days have passed. So 15 days worth of interest on this note should be recorded. We need to determine the amount of interest that applies to 15 days. We do that by multiplying the total interest by 15 days divided by the total number of days, which is 60. This is the same way we determined the amount in the previous example. So we have $200 times 15 over 60, which equals $50. The textbook describes the calculation by using the interest formula, which results in the same amount. Now we record the adjusting entry on December 31st. We record a debit to interest expense and a credit to discount on notes payable. We reduce discount on notes payable from 200 to 150 by doing this. When the note reaches maturity in the next year, the remaining 150 is then reduced with another credit to discounts on notes payable and a debit to interest expense of 150. By making these adjusting entries, we have recorded interest expense in the accounting period in which it's incurred, which is the matching principle you learned about in Accounting 110. So I'd like to wrap up this chapter with one last problem. So let's do exercise 14B-5 on page 545. Jamie Souza negotiated a bank loan for $39,000 for 240 days at a bank rate of $12,000. Assuming the interest is deducted in advance, prepare the entry for Jamie to record the bank loan. So this is an example of discounting one's own note, where we use the account called Discount on Notes Payable. The maturity value is $39,000 and the interest rate is 12%. So let's calculate the amount of the bank discount. So the bank discount is equal to the maturity value times the rate times time. Now it's a 240-day note. So again, we put that in terms of a year, 240 over 360. So we get $3,120. Now let's calculate the proceeds. Proceeds is equal to the maturity value minus the bank discount that we just calculated, which equals $35,880. So this is the amount of cash that Jamie receives. So let's record this as a journal entry. So we have a debit to cash of $35,880. And then we have that new account, discount on notes payable of $3,120. I'm going to fix the formatting of my debits and credits here, the account names are long. Okay, and finally we have a note payable, which is a liability, and the amount of the note payable is $39,000. Okay, so that concludes the chapter on notes receivable and notes payable. Be sure to learn the vocabulary that's used. It will help you analyze the transactions so you can make the computations and record the journal entries correctly.